balance of payment today. So today's discussion is all about balance of payment. What is balance of payment? Basically, when you're looking at a country has is receiving money, also a country is paying money from outside the country. So a lot of times the receipts of money can be happening because of a country having more of exports. When you look at exports, exports revenue. When you look at uh, exports revenue is what we call an outflow of goods but inflow of money, right? And imports is what we call um, inflow of goods but outflow of money, right? So when you are buying goods and services from abroad, you are basically importing them, and those imports will be an outflow of money because you need to pay. Let's say I'm buying a Japanese car, so in order to buy a Japanese car, I may need to pay in yen to a Japanese producer, and that would mean my rupee will be converted into yen, and that yen will go to Japan while the car will come to Pakistan. So, what is the balance of payment basically? A balance of payment is basically a record of the value of all the transactions between the country's residents, so residents of the country, and the residents of all other countries in the world. So, we are looking at all the transactions that takes place between one country's residents and other countries' residents. So, whenever you are receiving money, so receipts of money that you look at in a country, any receipt of money from abroad, we are recording it as credit. So all the inflows, in other words, all the inflows of the country. Now I want you guys to write this. All the inflows are basically your credit values. Because it's like those students who are studying accounts. Uh, remember remember there is a debit and credit, right, in accounting. So because balance of payment is an account of all the money that you're recording, all the money that you're getting from in the country, or the money that you're paying to other countries. So any inflow, we'll look at it as a credit entry. Okay. And whenever there's any inflow, we also we record it with a positive sign. Okay. So all the inflows that you receive in a country, for example, because of, let's say, you have done some exports, or let's say if somebody is coming to Pakistan for tourism, all of those will result in inflow of money, and that will be recorded as a positive, as a positive sign or credit entry. And similarly, all the outflows are recorded as a debit entry and are also recorded with a negative sign. So outflows, because they reduce your money, so basically you'll record it as a debit entry or negative sign. So we wrote this here, that receipts of money from abroad are regarded as credit entries, while while the money that is sort of recorded as all the outflows are regarded as debits or are entered with a negative sign. Mohammed Ali saying my voice is lagging. Is that the case happening with everyone? Is my voice lagging or something? Okay, sorry. Mohammed Ali, there might be a connection issue at your end. Okay, so guys, so this is the story of balance of payment. So what are the various things that come in balance of payment? We'll talk about this in 1 minute. But you need to remember this, that anytime there is what we call a debit entry in the whenever we see a negative sign, for example, you need to understand there must be an outflow, while a positive sign will be an inflow. And the fact that any inflow that happen in a country would be a credit entry, while any sort of outflow that happens in a country would be a debit entry. So credit entry for inflow, debit entry for outflow. Inflows are recorded as a positive sign, and outflow is recorded as a negative sign. So before I move on, I want to quickly also talk about, just to give you a picture of the various sort of sections that are out there. We're going to see this in notes as well, but let's talk about the various sections that are out there. So when you look at your balance of payment, we have what we call a current account. You have current account. You have what we call our capital account. And then we have our financial account. Okay. I should say AC for account. Account is AC. Let me just write that as short form. So let's just copy this, guys. This is useful to copy just to have a roadmap of things. Just copy it 1 minute. And I also want to say this: when you look at current account, you have in the current account, you have basically uh, exports of exports of goods. I'm sorry, not exports, but basically your visible or exports of goods and services, exports, imports, I should say, exports, imports of goods and services. And by the way, this is called when they are goods, they're called for goods, we call it basically visible balance, visible balance. And for services, we call it invisible balance. And the reason is very simple because balance, by the way, means x minus m of goods, and this is x minus m of services. So what we do is this, that we find out what we call our x minus m. We look at our x minus m of goods and services. So for example, look at this, guys. This on my in my current account, for example, the first thing is the current account balance. Your current account balance would have x and m of goods. So this x and m of good is basically what we call visible balance. And x is, for example, 21,469. Imports is in general of goods is like 32,915. And therefore visible balance is your x minus m of goods. And that's a negative value, negative 11,446. Then you look at your x and m of services, which is what we call invisible balance, which is this 5 and negative 5 and 3 value. And then in your current account, we add two more things. And those two more things are your incomes. And I'm going to explain this in 1 minute, what those incomes are. You can see this incomes balance here is also included. And the last thing we use in our current account to be included is called transfers. And that's basically this value transfers. And if you add A plus B plus C, you will have a current account balance of minus 1368. So the first thing we look at is current account. Now, current account is the most important account in your balance of payment because will it will basically record all the exports and imports of goods, all the exports and imports of services. And that exports and imports of goods and services, the visible plus your invisible balance. So this visible balance or plus your invisible balance is called sometimes balance of trade. So if somebody asks you in your MCQs or whatever, what is balance of trade? Balance of trade is basically your X minus M of goods and services. Okay. If you want to look at separately, goods is visible balance plus invisible balance. So what is, in short, what is balance of trade? Balance of trade is your X minus M of visible, or in other words, it's your visible plus invisible balance. So I should write this: visible plus invisible balance. Got it? Does that make sense? Then comes the incomes, like all the incomes that a country is receiving versus paying. So, for example, let's say I own an apartment in the UK and I receive rent for that apartment. That rent is an income. And so that rent will come in the income section of the balance of payment. So for example, if it's a money that is received by a resident in the country, I should record that as a positive entry. But if it's an income that is paid by a resident, for example, I own an apartment in or I rent an apartment in Karachi, but the landlord is living in the UK and the money is going to the UK. Therefore, there will be a transfer, that there will be an income which is an outflow. So all the rent, the wages, the profits, right? Or even rent, wages, profits. What's the fourth thing? Interest payments. All these incomes that are coming and going out of the country will be part of the income section of the current account. Does that make sense? Remittance is, Amar, that's a good question. Remittance comes in transfers. So remittance are what? Uh, Transfers are basically all those payments for which no good slash service is produced in return is called your transfer. So, for example, what is remittances? Remittances are basically those payments which are basically sent by, let's say, workers living outside the country back into the country. So, remittance will be basically part of transfers. Does that make sense, guys? So, if I quickly read the notes, so is remittance part of income, Amber? Therefore, no, remittance is part of money for which people in Pakistan are not making that output. Somebody else is working and then sending the money back home. That will be part of your transfer section. Okay. So, what is current account? Current account is recording all the imports and exports of goods and services, plus income flowing into and out of the country, plus net transfers into and out of the country. So uh, the trade in goods and services basically called visible balance. The trade in imports is called invisible balance, and basically uh, this is also called balance of trade. As I just explained that, it's called balance of trade. The current transfers, something was also Arisha is also asking me, give me example of current transfers. This is a good one. So this is a measurement of the net transfers of money from abroad. These are payments made between countries where no goods and services change hand. For example, a government at the government level, these payments may include foreign aid. If US gives Pakistan, if US gives Pakistan any foreign aid, do they want any output in return? And the answer is no. All the foreign aids and grants will be part of transfer. Similarly, at an individual level, foreign workers are sending money back to their families in their home. That is what we call remittances. That is also basically called a transfer. Or, for example, your grandmother who lives in the US sends you a private gift, right? And if she sends you this gift of like uh, $500, that will also be part of your transfer. Why? Because you're not producing any good in return. One of the most sort of common way in Pakistan where people are basically trying to make their unaccounted tax money uh, to become sort of white money, they use this sort of method. Anytime you receive dollars from abroad, the government of Pakistan does not ask you what's the source of it, because that will basically build Pakistan's reserves. All this money, by the way, are helping Pakistan to get inflow, and that's why anytime you receive that money, it will be considered as uh, it is considered as a transfer and is actually sort of non-taxable income. So that's why a lot of times people who want to convert their sort of money, which is not which is called black money, into white money, into taxable money, they may do this through the transfers of private gift. Just an extra sort of explanation. So are we happy with current transfers? Are we good to move on? So what are current transfers? These are all these payments for which no output is produced in return, like grants, like foreign aid, like for example, even remittances and private gifts. Okay, Arisha, are we good to move on? Then comes your net income flows. What are net income flows? Net income flows are basically all the incomes that are flowing into the country. Incomes can happen because of, they're also called net investment income, by the way, or net factor income from abroad. And they include profit, interest, dividends, rents, and so on and so forth. And that's why when you look at current account balance will include uh, your balance of trade in goods plus balance of trade in services plus net income flows and transfers. All of this included will be your current account balance. And it is the most important account in the BOP, in the balance of payment equilibrium. So BOP in the balance of payment account, this is probably one of the most important account because it includes all the goods and services as well as incomes happening. Haris, what is your question? You saying how is it made? As in it's made, people account for it. What do you mean by how is it made? Can you help me asking, be a little more clear as in how is it made? When we say it's made, yeah, it's like a ledger, exactly. Is it a ledger? Is Yeah, it's like a ledger form with debit and credit, exactly. And the government is making it. Okay. Now comes an important part. Note that any of these accounts, like balance of trade in goods or whatever, can be in surplus or deficit anytime. There could be a deficit in the trade in goods, a surplus in the trade in services, a surplus in the net income, and an overall surplus in the current account. What we're saying to say is this, that you could have any of these things in surplus or deficit for current account balance to be surplus or deficit. So because the current account balance makes up is made up of many components like goods and services, income flows, and net transfers, any of these can be positive or negative, and so on. Okay, so that's the first thing. Then comes capital account. Now capital account is a very, what you call, unimportant account because it doesn't really include major items, and that's why a lot of discussion is always about financial account and current account, but not so much about capital account, because capital account, first of all, includes few things. The first one is it is recording all the flow of funds which are happening because of acquisition, buying, or selling. So it's called acquisition or disposal of fixed assets. So anytime you buy or sell fixed assets, like a house, like something which is immovable, or there is a transfer of funds by migrants. Let's say I am leaving Pakistan for good, and I transfer my funds from Pakistan to the US. Then that will be a migrant transferring money, or the payment of grants by the government, like any grant that is received by the government. Let's say Pakistan receives a grant from IMF to build a dam. Let's say any grant will also be part of this capital account. So a capital account basically includes buying and selling of fixed assets, okay, money that comes because buying or selling of mixed fixed assets, or money that is going out because of buying or selling of fixed assets. uh, Similarly, transfer of funds that is happening, or payments of grants, all of this will be part of your capital account. Got it? Foreign direct investment comes in capital account. No, foreign direct investments we're going to talk about, it will come in the financial account, Amar. So wait for the financial account, because all the investments are coming in the financial account. But are we happy with the capital account? So buying and selling of fixed assets, transfer of funds by migrants, and the payments by government of to the government to for projects will be part of your capital account. Then comes financial account. So now financial account is a very important account because it is looking at all these investment, as Amar was asking me, direct investment. But Amar, this is where the investment part will come. So a financial account is recording the flow of money into and out of the country for the purpose of investment. So all the investments are coming here, or as deposits in banks and other financial institutions. So for example, anytime a bank in Pakistan receives money from another bank in the US or UK or whatever, that will be part of your financial account. And I'll talk about why this happens in a little while. But these deposits that are coming in sometimes can be coming in because Pakistan interest rate may be high. So if, let's say, Pakistan interest rates is like 10%, okay, R for interest rate is 10%. Okay, let me call it RP for Pakistan. And let's say our sort of US is like 5%. So if people put their money in Pakistan because Pakistan interest rates are higher, right? So Pakistan receives an inflow of money that is coming because Pakistan interest rates are higher. That will be part of financial account because that will become money coming in the deposits. We also call this money, we'll talk about this later, we call this money hot money or short term monetary flow. And this money is received primarily because your interest rates are probably higher than the US interest rate. So if that happens, this is called, yeah, it's a funny name, it's called hot money or short-term monetary flow, which is happening because your country's interest rates are higher than the, for example, US interest rates. Anyways, what does this financial account cover? We say this financial account covers basically number one, direct and portfolio investments. So that's number one. Number one is your investments. And within investments, we're looking at your direct investment, and your, let me zoom this, and your portfolio investments. What is direct investment? Direct investment is when, for example, we are investing in physical assets. Like, for example, we are building a store. So I'll give you an example. Let's say Apple, the company Apple, decides to make a store in Pakistan. That will be called what we call direct investment, because this is where money is coming into the country to invest on physical assets. Remember, this is not fixed assets, it's a physical assets I'm investing in the country, right? What says portfolio investment is the investment that is on financial assets. Financial assets are shares, financial assets could be bonds, and so on and so forth. Haris is asking me what is the difference between current and financial account. Both record inflow. All these, Haris, all these accounts are recording inflow. Current account is recording inflow of X minus M of goods and services. Also, it's recording incomes. Also, it's recording transfers. Capital account is recording the inflows and outflows of fixed assets, grants, and all that. While now your financial account is recording investment. A good example of this is that, let's say I decide to build a factory in the UK. That will mean this will be called an outflow from my from Pakistan's financial account, because a Pakistani decides to make a factory in the UK means money will be going out of Pakistan. There will be an outflow. But let's say after 2 years, I receive profits in my from my factory. Where will it be recorded? And the answer to this is it will be recorded in the current account section, and that too in the current account net income flows. So my inflows, net income flows, may this will be recorded as profit. So a lot of times when we are investing, we are making an outflow from our, let's say if I'm doing an international investment, I'm making an outflow from my investment account, from my financial account, but that will be coming in later in my income section of my current account as profits. So what's the difference between direct investment versus portfolio? Portfolio is in shares, direct is in its assets. You build a factory, that's direct investment. You buy the shares of a already established company, that will be portfolio. Then comes number two. Number two is what we call your other financial flows. The other financial flows is also called your short-term monetary movement between the countries, and may include deposits and short-term loans. Anytime, let's say I gave an example earlier, anytime Pakistan interest rate is higher, we saw sometimes people are putting money in Pakistan because of our interest rates to be better. We say hot money flows in, and when hot money flows in, it goes into this financial flows account. Got it? Does that make sense? So what is your financial account so far? It includes all the investments. It includes all the deposits. Number two is all the deposits. Could be because your interest rates are higher. And number three, there's also called another section called reserves. I'm going to explain this in 1 minute, but before I explain that, I want to know if there's any questions about our discussion so far. And Haris, just a request, can you, when you write a question, can you write it to everyone so that everyone knows or what your question is? It's good to ask a question so that everyone can read that. That'll be better. Sir, explain two again. Two Sager is simply all the money that is coming to your country's bank accounts, and they could also they could be coming for only short-term monetary reason. It could be very short-term reason because your interest rates are better. If your interest rates are better, it is basically going to make your country's deposits to go up. Capital account, Jyotish, is simply account that has three things. Number one is buying and selling of fixed assets. Number two is transferring of funds by migrants, like those who are leaving the country for good or coming to the country for good, and the payment of grant by the government for projects. If a Pakistani government received, let's say, a grant for, let's say, building a dam, that will be coming into the capital account of your balance of payment. Okay. Reserves is an important thing to understand. We say reserve is basically a section. Let's say, and I want to go back to this one. I want to go back to, before I talk about reserves, this is an important thing to understand that, let's say you have a current account and capital account and financial account. Let's say current account is overall in a surplus of plus 20. Okay. Capital account is 0. Okay. And let's say financial account is minus 10. Okay. If current account is plus 20, okay, capital account is 0 and financial account is minus 10, what is the balance of payment, total balance going to be? Plus 20 minus 10 is equal to, anyone? Plus 20 minus 10 is equal to plus 10. Now this plus 10 basically means your balance of payment is in a surplus. So whenever your balance of payment is in a surplus, I will take this money out, and I will take this money out by making my reserve to become a minus 10. I will take this money out from my reserve so that my balance of payment will balance to 0. We say balance of payment should always balance to 0, which means if ever there is a surplus, like in this case, current account was a surplus, capital account 0 tha, financial account was minus 10, so plus 20 plus 0 minus 10 is plus 10. This plus 10 balance, you take it out from reserves and you basically make this balance of payment 0. Where do you take it out? Basically, this is going to make your reserves, like you must have heard in the newspaper, sometimes they say the country's reserves are building up. So my reserves has built up by 10, so my more money is flowing in. Let me do another example. Let's say this was not plus 20, let's say this was minus 20. Okay. And let's say this was minus 10. Now what's my balance figure, guys? What's my balance figure? Minus 20 plus 0 minus 10 equals to minus 20 plus 0 minus 10 equals to minus exactly minus 30. So what will happen is, now this country has to pay outsiders minus 30, because this is what the outflows are, which means we need to pay foreigners minus 30. We owe this money, which means I will plug this plus 30. I will make this plus 30 to happen. So in other words, reserve is what we call a balancing item. It is trying to balance this balance of payment to 0. Anytime this balance of payment is in a surplus, it will help us to build up reserves. So यहाँ पे आप एक minus entry करोगे, or anytime this is in negative, then you need to plug in because you owe this much money. The balance of payment, put a 30 from reserve. Exactly, you will plug this 30 from reserve. You will build this 30. You will put this 30 in so that the gap of minus 30 goes away. Now, minus 30 का मतलब ये हुआ, अगर balance of payment अगर minus 30 बताता है, this minus 30 means we owe money to foreigners. And plus 30 would mean, basically, if this number was a plus 30, This means that we actually, people owe us this much money. We are actually receiving more money. So if I look at this, can you wait for me for 1 minute? Reserve of gold and foreign currencies, which all countries hold and which are itemized in the official reserve account. So there's an official reserve account. It is movement into and out of this account that will ensure the balance of payment will always balance to zero. We should say the balance of payment should always balance to zero, because jab kabhi bhi, whenever there's a shortfall, we should bridge that shortfall by taking money from reserves. But whenever there is a surplus, we will take the 30 away for future deficits. So if there's a surplus in all of the other accounts combined, then this official reserve will increase. We will increase the official reserves because there's a surplus in the BOP, right? If there's a deficit in all of the other accounts combined, let's say current account plus capital account plus financial account, then we say this, that we will decrease the overall reserves. Why? Because if there's a deficit, I will take the money from my reserves and plug it in here. So Zainab is asking us, why do we owe to the foreigners? Well, Zainab, think of this way: अगर आपने गाड़ी खरीदी from Japanese, if you buy a car from Japanese, you have to pay them in the foreign currency like yen. Okay, normally you should have enough foreign currency in your country to pay the foreigners. But if your country do not have enough inflows coming, then basically any outflow that you make, let's say Pakistan, the biggest problem Pakistan is facing right now is that because of our lack of exports, we do not have money to buy imports. When you don't have money to buy imports, let's say dollars or whatever, uh, you don't have enough dollars to buy foreign goods, then you may need to borrow money from abroad to pay those dollar liabilities. Ideally, you should have strong reserves so that you can easily pay off any liabilities. But whenever a country doesn't have, let's say अगर आपको गाड़ी खरीदनी है, let's say Zainab says I want to buy, let's say, a US car, then Zainab has to take the rupees into the market, convert the rupees into dollars, and then send those dollars abroad. Now, if the economy doesn't have those dollars, then they will have to borrow money from outside to pay to undertake that transaction. So what we're saying is this, that if the current account plus capital account plus financial account overall is in surplus, you will balance it to zero by building the reserves. But if overall if your current account plus capital account plus financial account is in a deficit, you will plug that gap by bringing down your reserves. When a country is running into a balance of payment surplus, we say its reserves are really strong. Strong reserves are a great healthy indicator, or a great health indicator of a country, because it tells you that you have a strong base for exports to take place. Haris is asking me, what are the effects of the on the economy when we put or um, take out an amount of BOP? Uh, Haris, if you are taking money from the reserves will deplete. And once the reserve deplete to a very low level, which has happened with Pakistan, then you have to start borrowing money to pay for your foreign liabilities or foreign transactions, which is not good news for a country. On the other hand, if your reserves are strong because your balance of payment is in a, now China, I'll give you an example. China has strong reserves of gold and foreign currencies. China, by the way, has bought a lot of gold from the markets because their balance of payment was in surplus. Every time they had foreign currencies, they would either put money in the gold market or they would have strong reserves. China has built up those reserves through running into balance of payment surpluses for many, many years. So balance of payment for them is extremely strong, or extremely healthy. Now, I want to wrap this discussion up very quickly. So when we say your current account plus your capital account plus financial account is equal to your balance of payment, we add one more section here. It's called errors and omissions. What are errors and omissions? Errors and omissions are basically, how many of you doing accounting, those of you do accounting would know something called a suspense account. Remember suspense account? Suspense account is an account that you build because you must have made some mistakes, and that's why your account is not balancing. And what you do is that we need to then correct your balance of payment, your accounting issues through suspense account. So in a way, this errors and omissions is basically the value. Let's say current account was 20, capital account was 10, and financial account was minus minus 40. Okay, but there could be errors and omissions that will also be here, which is basically trying to look into account any accounting error. So any accounting error which is only for short term will be put into a errors and omission. Let me read this here that uh, in line with the international standards as set up by IMF, the accounts are divided into three categories: current account, capital account, and financial account. In addition, it is important to identify transactions in reserves assets. We talked about that. Taken together, these items should all sum to zero. But let's say this 20 plus 10 is 30. 30 minus 40 is minus 10. Let's say you have a minus 10 happening, even though you have taken into account all the reserve account as well. Then maybe you might have done a mistake of 10, and that 10 could be basically your errors and omissions. So, however, because it is possible to record everything accurately, it is not possible to record everything accurately. A final item called errors and omissions, or the balancing item, sometimes ensure overall balance. So if somebody asks you, why should BOP always be zero? Because if BOP is not always zero, then basically you can take money from the reserves and make it zero, or take money out from the BOP and make it zero. Also, we add errors and omissions here for all the mistakes that you could have. Why should it be zero? Because zero means that you are, if it's zero, this means there's neither a liability nor there's a surplus. Okay, is it always better to be in a surplus, Haris? Yes, it's always good to be in a surplus, but there are sometimes problems of a surplus, which we'll also discuss in a chapter, a later discussion. But it's always preferred to have a BOP in surplus, because that means more money is coming in than going out. This means you have strong reserves, and therefore you have a strong trade. Does that make sense? So this is your balance of payment discussion. Is there any questions? I have few minutes to take questions. Is the class over? And the answer is yes, the class is over, unless you have a question. And I'm going to stop recording, and we are done.